Howdy, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, March 24th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is the Trump put close to being activated? Our answers are U.S. stocks are off to a positive start to the week, with the S&P 500 and NASDAQ 100 up over 1% apiece, as investors speculated on more nuanced, less destructive tariff measures. Market participants are drawing relief from indications that Trump's so-called Liberation Day tariffs may be more surgical than the scorched earth rhetoric he previously signaled. According to administration sources, the April 2nd rollout won't include sector-specific tariff packages, calming fears of an all-out trade war. The tariff regime is shaping up to be narrower in scope, with exemptions for some countries and no stacking of existing steel or aluminum tariffs. Still, President Trump wants fast results, with tariffs designed to hit immediately upon announcement, per White House insiders. Despite internal back and forth on execution, the president remains among the most hawkish voices within his administration, pushing for visible impact. April 2nd is going to be a liberation day for America, President Trump declared, touting tens of billions, potentially trillions in tariff revenue over time. We've carefully studied every meaningful interview with key members of the cabinet over the past few months, and our analysis leads us to conclude the strike price of the Trump put is much lower than where markets are currently pricing it today. Shifting gears, happy dot-com bubble anniversary. 25 years ago, on March 24th, 2000, the S&P 500 hit a peak that it wouldn't reclaim until 2007. 3 days before the NASDAQ 100 hit its dot-com bubble high that it wouldn't reclaim for 15 years. The 1995 to 2000 bull run saw the S&P 500 nearly triple, and the NASDAQ 100 surged nearly 718%, only to crash, wiping out 80% of the NASDAQ's value by 2002. If you were still overweight U.S. stocks in March 2000, like most investors were, what lessons did you learn from that market cycle that you can apply to today's market cycle? Transitioning to our 42 macro dashboard, as always, a wrap up with the question here from our community. This one's regarding failed Treasury auction. It says, hi, just watched an interview with Soros Fund CIO Don Fitzpatrick. Towards the end, she says that it's possible within the next couple of years that a failed Treasury auction from an EU country, and she gives France and UK as possible countries given their high levels of debt. She could just be talking up there up the fund's own position, but there isn't any precedence for something like this to happen. So yeah, we definitely saw it in the fall of 2022 with the Liz Truss moment. We essentially saw the gilt market melt down and basically go no bid for a brief period of time until the Bank of England came in and stepped in and started expanding its balance sheet again. I think the risk of a failed Treasury auction is probably higher in the U.S., just given our more precarious starting point. We have higher debt than most of those European countries in terms of debt to GDP ratios. If you certainly look at it on a debt to liquidity basis, we're kind of in no man's land on that metric relative to the rest of our peer economies. And then obviously you look at our deficit, which is currently tracking at a little bit over 7% of GDP. Now, obviously, the Trump administration, and particularly Treasury Secretary Scott Bessent, has authored some guidance that they would love to get the deficit down to 3 percentage points of GDP. But the reality is one, they can't do that overnight without causing a recession in the economy. And two, it's not clear they're going to be able to do that anyway when you factor in some of the dynamics that we're seeing with respect to the extension and expansion of the Trump tax cuts. You essentially have the scenario where Doge, at least according to our estimates, is going to wind up cutting about $500 billion to $1 trillion out of annual federal expenditures. Meanwhile, you're layering on about, kind of $4 to $5 trillion of additional lost revenues in the context of the tax cuts relative to the current law baseline, which has most of the provisions within the Trump tax cuts expiring on December 31st of this year. Not the least of those provisions are no tax on tips, no tax on overtime pay. They're going to have to increase the SALT deduction in order to get the salty Republicans to play ball. So you have a lot more revenue reduction coming down the pipe from a legislative standpoint than you have from a deficit reduction standpoint. So investors should be aware of that in terms of the net impact that they may have on the budget deficit. Now, obviously, the President Trump administration, on balance, is calling for a pro-growth administration where deregulation, tax cuts, and accelerated energy production are all things that could contribute to a faster potential growth. They're essentially calling for 3+% growth. When you think about their dynamic scoring of their budget resolution, that'll feed into the reconciliation process. Whereas most bipartisan budget think tanks they're saying the impact on growth from these policies to not be as positive. It is net positive, but it's much less net positive. I want to say that when we did the analysis, looking at the seven largest kind of most well-known bipartisan think tanks on deficit matters, their median estimate for how much the dynamic scoring would ultimately impact positive growth in revenues relative to the baseline is somewhere around 200 billion, whereas the House Republicans estimate is somewhere around 2.6 trillion. So there's obviously a huge dichotomy relative to where I would say non folks who aren't incentivized to just sort of tell President Trump what he wants to hear relative to the people who are incentivized to do that. And then one final thing I'll say is on the budget deficit stuff that may increase the risk of a failed Treasury auction at some point in the future. If the Senate decides to go with the current law baseline, current policy baseline with respect to scoring the reconciliation package, as opposed to the current law baseline. The current policy baseline essentially assumes the cost of extending the current law Trump tax cuts, which again expire on December 31st of this year, as zero, which obviously free up trillions of dollars of additional tax cuts that they can layer on into the program. And so, you're talking about the potentiality for U.S. debt to GDP to be somewhere around 150%, kind of in a 10-year kind of budget window in the worst case scenario, but certainly looking at about 130%, up from about 105-ish, 110% currently. So, these are dynamics that we all continue to see. I don't think the Treasury market is overly concerned about them right now, and they shouldn't be, because clearly, in our opinion, we have a faster than expected growth slowdown ahead of us that has to get priced in our opinion. But ultimately, when we get to the other side of the legislation of the extension and expansion of the Trump tax cuts, and kind of just move forward in time, the risk of seeing a failed Treasury auction here in the U.S. Will, in our opinion, will be quite high as we move forward in time over the next few years, because ultimately we just think the bond market is very inadequately priced for the amount of supply that's probably going to come down the pike. And one of the most important dynamics that is contributing to the risk of a potential failed Treasury auction in subsequent years is the fact that the private non-bank sector, which used to own 36% of treasuries at the end of 2021, now owns 57% of marketable treasuries, and that share continues to rise. So eventually we, the private sector, will buckle under the weight of Uncle Sam, especially if Uncle Sam continues to get fat, if Uncle Sam's weight continues to go up, as it likely would in the context of trillions of dollars of tax cuts with not the same level of spending cuts to offset that. So we'll wrap it up there. Hopefully everyone understood that and benefited from that. Nothing to do here today on this, but I do think it's a very important topic for our time, given that we are in a fourth turning, and typically you see some pretty exciting things, both economically and within financial markets late in fourth turning. So wrap it up there, everyone. Have a wonderful day. Darius Dale here, presenting our Macro Minute for Monday, March 24th, 2025. Best of luck out there. We'll catch you back here tomorrow. Cheers.